Hello everyone, welcome to our discussion sessions on official mock exam issued by ACCA for December 2025 exam attempt for advanced taxation course. In our today's class, we will be looking at question number 2 of this official mock exam. Practice of complete exam papers near the examination is really important for your exam preparation because it gives you an idea that how you have to deal with all of the topics together in your actual examination in a time restricted situation. In these discussion sessions, we are looking at these exam questions in a lot of detail. And along with that, we are using my life-saving summary notes in which I have summarized the entire course of advanced taxation in just 57 pages. Okay, if you have these summary notes, it's a real blessing in these last few days because it helps you to do revision in a great manner. Most of you guys already know me. I'm Owais Mirchawala, top tutor for advanced taxation, and my more than 70 of the students have secured nationwide positions in the examinations which I teach, including advanced taxation, advanced audit and assurance, and SVL exam of ACCA. So without spending more time, let's deep dive into this question and do a detailed review of this question. Okay, we'll be doing a detailed reading of all the introduction and the exhibit. Then we'll be looking at the requirement, and at last we'll draft the complete answer in our today's class in this word processor document. So you will be able to understand that how exactly you have to deal with the actual question in the examination, how the reading has to be done, then how the drafting, and how much you have to write in your examination. So let's start with it. You should assume that today's date is 3rd December 2025. You are an ACCA student working for a firm of accountants. Your manager has been in discussion with Suzanne and John, clients of your firm. Suzanne and John have requested advice in respect of the disposal of chargeable assets, the optimum relief available for trading loss, and the implications of voluntary VAT registration. The following exhibits, which is available on the left hand side of the screen, provides information relevant to the question, which we'll obviously be reading. See, when you look at this introduction, it's just briefly the examiner tells you that what this question will be about. Okay, like there is some CGT issue, there is some trading loss relief, and VAT registration matter. The information should be used to answer the question requirement within your chosen response options. We'll be actually using these response options in our today's class when we will draft the answer. Okay, so let's look at exhibit 1, Suzanne and John. I want you all to listen to me very carefully as we move forward. Suzanne is resident and domiciled in UK. Suzanne has been married to John for 20 years. Suzanne will have a taxable income of £60,000 in the tax year 25-26. So this shows that currently Suzanne is a higher rate taxpayer if she gets anything additional, because taxable income of £60,000 show that the basic rate band of £37,700 is already used. Okay. See, when you are reading the question, the key is that you don't have to rush. Read with patience. Try and identify maximum possible data, which can then be used while you will be drafting the answer. Okay. Now, Suzanne's proposed disposal. Suzanne wishes to sell a 15-hectare plot of land on 31st of March 2026, which is valued at £80,000. These 15 hectares were originally part of a 26-hectare plot of land, which was purchased by Suzanne on 1st March 2019 for a cost of £56,000. So she originally purchased 26 hectares, and from that, she's currently selling 15 hectares of the land. So this is a situation of part disposal. I hope you all remember the cost allocation treatments of the part disposal. Okay, if you don't remember, you just have these life-saving summary notes. Just go and write part disposal and you get the treatment, that how you allocate the cost of disposed part and all. Okay, now Suzanne sold 11 hectares of land on 1st May 22. That's very interesting. She purchased in 2019. 11 hectares were sold in 2022, which is not our current tax year. Our current tax year is 25-26, in which she is selling the remaining 15 hectares. So this is not the part disposal first slot, it's the second slot. First slot was already sold in May 22. So at that time, the calculation of base cost must have been done. When we will be solving it, we will be looking at it. The remaining 15 acres were valued at 65,000 pounds on that date. So basically, when today Suzanne is selling 15 hectares, and when she will be writing cost of disposed part, she will write total cost of the land, that is 56,000, and then cost of disposed part of 11 hectares already used in May 22 will be deducted from it. So she will get the base cost or cost of remaining asset which would be allocated to these 15 hectares which happened in May 22. When we'll solve it, believe me, it's very easy. And we have looked at one past paper question in other revision sessions also. As you know that in my course, I have covered more than 7 complete attempt exam papers. The land is used for keeping horses on it, like it's not a business thing or something like that. Suzanne annual exemption amount has already been used on earlier disposals in the tax year 25-26. So annual exemption is already used, like that 3,000 pound annual exemption. You don't have to claim it again. Now comes John. John received dividend of 5,000 pounds each tax year. John received insurance proceeds of 20,000 pounds on 1st October 25 following the destruction of a painting. The painting had originally cost him 28,000 pounds, but was valued at 20,000 pounds on 1st September 25, shortly before it was destroyed. See, when anything gets destroyed, you write disposal proceed as insurance or scrap proceed and you deduct your cost. Market value has nothing to do with it. So apparently on this painting, he suffered a loss because cost was 28, whereas insurance proceed he received was 20,000. Then he also sold some quoted shares on 1st November 25, which gave rise to him of a chargeable gain of 9,600 pounds. John will make no other disposals for capital gain tax purpose in the tax year 25-26. And John has no other income than the dividend and the trading income. Okay. For trading income, we need to read about his business. So see, we are reading the question, picking up the data, identifying that, okay, what rules can apply. Then comes discussion about the John's business. John has been in business as an unincorporated sole trader since 2019. The business is not VAT registered, but makes supplies that would be treated as wholly exempt under the VAT legislation. The business has the following actual and budgeted tax adjusted trading profit and loss for the 3-year period. In 24, it had a profit. In 25, it had a profit. But in 2026, it suffered a loss. Now, Suzanne and John tax plan. Suzanne and John wish to take all necessary actions to minimize the total tax payable by them as a couple. Suzanne has heard that there is a scope to save tax through the transfer of assets between the spouse. See, between the spouse, the assets transferred at their cost. Okay. But since John has some trading loss, so if he get the gains, he can offset and get some saving. And apparently, John is also a basic rate taxpayer because his business is in loss, whereas Suzanne is a higher rate taxpayer, earning 60,000. Okay, so apparently the sale of 15 hectares of land on which Suzanne is making a gain because it is being sold for 80,000. The cost of 26 hectares was 26 or 56,000. So obviously the cost would be much lower for 15 hectares. So this disposal of land is a gain transaction. So if it gets transferred to John, maybe it can save tax. But we'll deep dive into all of the issues as we move forward. So don't worry. John has heard that voluntary registration of business may mean that he can reclaim the tax from HMRC. But the problem is that the supplies which he is dealing in are exempt supplies. So you cannot recover the VAT if you are dealing in exempt supplies. Still, we have read this exhibit. Now let's look at the requirements and then deep dive into each part. Apparently, it's an easy one. Apparently, there is nothing which I believe would create any problem in this question. Part A. Explain with supporting calculation the couple's total capital gain tax liability for the tax year 25-26 before any reliefs are claimed. If Suzanne disposes the plot of land on 31st March 26 as proposed, a 4 marks required. So obviously 4 marks is an easy requirement. Let's look at it. We have to calculate the CGT liability. So the question is Suzanne and John, and this is our requirement which we are dealing in. Okay, you can copy paste the requirement in the examination so that it becomes easier. In question 2 and 3, you can do this behavior because in question 2 and 3, there are no marks of communication skills. So you just copy paste the requirement and you start developing your answer. So what we have to do is we have to explain with supporting calculation the capital gain tax liability for tax year 25-26 of who? Of the entire couple. Now, obviously, in the couple, if we talk about Suzanne first, so in the tax year 25-26, Suzanne has made a disposal of 15 hectares of plot of land. 31st March 26 is tax year of 25-26. So, listen to me carefully. In tax year 2025-26, Suzanne has made disposal of 15 hectares of land. Her CGT liability will be, let's look at it. I want you all to listen to me carefully. Now, if you want, you can do the calculations on the spreadsheet also. Okay. Or if you want, you can do them on the word processor document also. It's completely acceptable. It's your choice. I normally like solving the question on the single screen. So I use the word processor document and I use this table function. But if someone is comfortable on spreadsheet, it's completely acceptable. There is no issue in it. Okay. Now, so Suzanne has made a disposal of 15 hectares of land on 31st March 2026. Okay. Tax year, to be exact, ends on 5th of April. 5th April to 6th April is the tax year. So 31st March 26 is tax year 25-26. Okay. So she is selling the land for 80,000 pounds. I will copy the pound sign. So every time I will just press Ctrl V to paste it. So disposal proceed for 15 hectares of land. So it's 80,000 pounds, if I'm not wrong. Okay. Disposal proceed for 15 hectares of land is 80,000 pounds. Now comes the cost. These 15 hectares were originally part of 26 hectares of plot, which was purchased by Suzanne on 1st March 19 for total cost of 56. See, the problem is that she never purchased 15 hectares. She purchased 26 hectare land. So now, cost of 15 hectares of land. Now, we don't know the cost because 15 hectares were never purchased. So now, cost of 26 hectares of land. I will add one more table here. Cost of 26 hectares of land. Just listen to me carefully. She purchased 26 hectares of land for 56,000 when? On 1st March 19. 56,000. Sorry. 56,000 purchased on 1st March 2019. Okay. See, it's very important that you listen to the things carefully so that you can understand them in a better manner. Now, from this 26 hectare, disposal of 11 hectares of land was done. Disposal of 11 hectares of land was done in 2022, and that was done for 38,000. So now, disposal of 11 hectares of land. So what was cost of 11 hectares? So at that time, total cost 56,000 into disposal proceed 38,000. Listen to me carefully. Disposal proceed 38,000 divided by disposal proceed 38,000 plus market value of remaining. What was the market value of remaining on that date? The remaining land was valued at 65,000 at that time. Sir, will you repeat it again? Yes, I will repeat it again. But the key is that you have to keep some patience. Okay. So 56,000 multiplied by 38,000 divided by 38,000 plus market value of remaining at that date. So that was 20,660. 20,660. So base cost for 15 hectares of land. So 56,000 minus 20,660. So that is 35,340. And that comes here. Sir, please repeat it again. Yes, I will repeat it again. But your patience is the key. Okay. So listen to me carefully. Now, so this disposal is being done on 31st March 2026. Disposal on 31st March 26. We need cost of 15 hectares of land. So originally 26 hectares of land were purchased. They were purchased for 56,000. From this, 11 hectares of land were sold on May 2022. So when 11 hectares were sold, at that time, the base cost working must have been done. See, look at the timeline. 2019, you purchased 26 hectares. In 22, you sold 11 hectares. So at that time, the working of part disposal must have been done. Cost multiplied by disposal proceed divided by disposal proceed plus market value of remaining. When 11 hectares were sold, so you must have got a base cost. That base cost is of 15 hectares, which you pasted it here. So this is the base cost for 15 hectares of land. So that gives you chargeable gain. So that chargeable gain will be 44,660. Annual exemption is already used. So this is your taxable gain 44,660. So your CGT will be 44,660 into 20% because Suzanne is a higher rate taxpayer. 8,932. Suzanne is a higher rate taxpayer due to her existing taxable income of how much? It's given in the question, taxable income of 60,000 pounds. Due to her existing taxable income of 60,000 pounds. Okay. So, sir, is it difficult? See, it's not difficult for a student who is good at CGT and who do the question in a confident manner. It's not done still. We have just done with Suzanne. We have to do for the entire couple. So in 25-26, Suzanne made disposal of 15 hectares of the land. So disposal proceed of 15 hectares, cost of 15 hectares. So we had cost of 26 hectares. From that, 11 hectares were sold in May 22. So then we got base cost of 15 hectares, which we shown here. Okay. Annual exemption was already used. You got taxable gain and you calculated the CGT liability. Now, John has made two disposals in tax year 2025-26. His CGT liability is how much? Sir, how do you know he has made two disposals? It's written here. John received insurance proceed thing and he also disposed some quoted shares. Okay, so let's look at it. I want you all to listen to me carefully. So now we are talking about John. Destruction of painting. Okay, so on destruction of painting, he got 20,000 pounds. Disposal proceed is equal to insurance proceed. He got 20,000 pounds. Cost of painting. What's the cost of painting? The cost of painting was 28,000. Market value is you don't have to do anything. It's not a damage that you will apply part disposal. You just have to apply the original cost. That's 28,000. 28,000. So we suffered a capital loss here of 8,000 pounds. Okay. So this is his destruction of painting thing. Very straightforward. then sold some quoted shares on 1st November 25, same tax year 25-26, which gave rise to chargeable gain of 9,600. Okay. Sale of shares. Chargeable gain is ready made available in the question, 9,600 pounds. So net chargeable gain for the year is 1,600 pounds. Okay. Now John has made no other disposals in the tax year. So this means that annual exemption is available 3,000 pounds. So the taxable gain will be 0 because annual exemption cannot create a loss for it. So destruction of painting, you got a capital loss on destruction of painting. On destruction of painting, then sale of shares, the gain was ready made available. You got net chargeable gain, you adjusted annual exemption, and the taxable gain was 0. So total CGT for the couple for tax year 2025-26 is 8,932 pounds, which Suzanne has to pay. John has no CGT situation. John has no CGT situation. I hope that you are understanding it. Will you repeat it, sir? Yes, I will repeat, because I love repeating the things. Okay, just a second. So, if you look at it, it was a 4 marks requirement in which we have to do the CGT. First was disposal of 15 hectares of land. You wrote disposal proceed, then cost of 15 hectares. That was an interesting thing because originally 26 were purchased, 11 were already sold in May 22. So when 11 was sold, the working of part disposal was relevant. Total cost into DP divided by DP plus market value of remaining. Base cost of 15 hectares go here. You get chargeable gain, annual exemption is already used, you get taxable gain. And then comes 2 disposals, destruction of painting by John and sale of shares. Okay. Annual exemption cannot create a loss, so the taxable gain was restricted to 0. Okay. Now, let's move forward. Part B1, what he's saying here. Okay, let me paste it here first. Now, state the loss relief available to John in respect of his budgeted trading loss of 21,000 pounds for the year ending 31st March 2026. It's just a 3 marks requirement. We just have to state the loss reliefs. Okay. So he has a loss relief in the tax year 31st March 26. So what this loss can do? You can offset current year total income in which he only has his dividend income. He only has his dividend income. Okay. Otherwise, the gains and losses have got offset against themselves. So he can offset his total income, which includes the dividend income, but that dividend income is already covered through personal loss. Another option is that he can carry back the loss to the previous year. Okay. In whatever year you offset the total income, you have an option to go for the capital gains. Last option is that you can carry forward against future trading income. So you just have to state the relief. Okay. So John can offset his trading loss of year ended 31st March 2026 against total income of 2025-26, which includes his dividend income currently. See, we just have to state the reliefs. Another option is that John can carry back his trading loss of 31st March of year ended 31st March 2026 against total income of previous year, of previous tax year of 2024-25. Okay. In that year, he has trading income and also dividend income. Okay. John can also offset capital gains of current year and previous year after he has set off total income of that particular year. Okay. Lastly, John can also carry forward trading loss against future trading income. Okay. So the question was to state the loss relief options. So the loss relief options for trading loss is current year total income, last 12 months total income, offset against the capital gains of current year or previous year. Once you have offset the total income, you always have an option to go for capital gains. Obviously, in 25-26, he has the capital gain, but they are already covered by the loss and the annual exemption. And lastly, John can also carry forward it against the future trading income. These are the trading loss relief options. I hope you all remember. If you don't remember, just go to individual losses. Okay. In the trading loss, you can find all of these options. Okay. You have already studied them. These summary notes are obviously very important for the revision phase and while you are doing these past papers. But make sure you are not very much dependent on them because in the exam, they won't be available. Then comes the bigger one, 11 marks requirement. Advise Suzanne and John to which approach to use the available loss relief will save them the most tax collectively. Support your advice with relevant calculation of the total tax which can be saved and any other actions the couple should take to achieve this. You should ignore NIC when answering this part. 11 marks required. So now I must say that this will be an interesting one. Okay, 11 marks is a big requirement. So let's look at it. Nothing to worry about. So advise Susan and John as to which approach for the use of available loss will save them the most tax collectively. Okay, so now we are discussing that in what way the maximum loss relief can be gained and what approaches are available. See, obviously, John has a 21,000 loss on his trading P&L. So we are exploring the options. What John can do is that John can offset his own total income of 31st March 26, in which year he only has this dividend income of 5,000 pounds. So obviously the dividend is already covered due to the personal allowance. So it won't generate any tax saving for John. And if John offsets the capital gains of 25-26, like this gain loss of painting and the gain of shares, so that will also not generate any benefit because we have just calculated it in the previous part that it was covered due to annual exemption. So let's see, while I develop the answer, you will be able to understand. John can offset, or I can say, if John offsets his trading loss of 31st March 2026 against his current year total income of 2025-26, which only includes dividend income of how much? 5,000 pounds. Let me copy the pound sign. Of 5,000 pounds. Copy is done through Control C and paste is done through Control V. Of 5,000 pounds, then tax saving will be zero as this dividend income is already covered due to his personal allowance of 2025-26. So if he offsets his current year total income, then benefit is zero because current year total income of 25-26, because his total incomes are his trading and dividend. So dividend is 5,000 in 25-26 and trade is in the loss. If John offsets his capital gains of 2025-26 after offsetting total income of 2025-26, tax benefit will still stand at 0 pounds. Capital gain, or I would say as net capital gain of 2025-26 after loss relief and annual exemption also stand at 0 pounds. So that's also not a benefit. Okay. If John carry backs his trading loss of 31st March 2026 to previous tax year of 2024-25 against trading income of how much? What's the trading income if you check it? The trading income is 18,000 pounds. And dividend is every year he gets a dividend of 5,000 pounds. Against trading income of 18,000 pounds and dividend income of 5,000 pounds, then he can generate a tax saving. Then obviously he can generate a tax saving. Okay. Now, his trading loss of 31st March 2026 year is, how much is his trading loss if you check it? His trading loss is 21,000 pounds. His trading loss of 31st March 2026 year is 21,000 pounds. Total income of 2024-25 is 18,000 pounds trading income plus 5,000 pounds dividend income, which gives us 23,000 pounds. Okay. So now we need to calculate his tax saving. So what will be his tax saving? Let's calculate that. So his tax saving will be, now in order to get the tax saving, there are two methods available. One method is that you solve it directly. Can be done by a student who is very good at these tax rate management. Because when you will offset this loss of 21,000 pounds against his total income of 23,000 pounds, you also need to think about wastage of personal allowance. Because when you will remove 21 from the 23 total income, the remaining income will be only 2,000. So his personal allowance will get wasted. And since dividend income is also getting involved, so the problem is that you have to deal with two set of tax rates. So what I think is that it's very difficult for a student to deal with this situation directly. So the safe method would be that what you will do is that you will calculate, his tax without loss relief, and one time you will calculate his tax with loss relief. So difference of both of the taxes will give you the answer. Okay. I will repeat the things again also. So just listen to me with patience and you will be able to understand the things in a better manner. Okay. Nothing to worry. If someone wants to do it directly, that's obviously possible. But since two set of tax rates are getting involved, personal allowance is getting involved, so it's better to avoid the direct method. Okay. So now trading income. Okay. One column is non-saving and one column is dividend in both of them. Dividend. Okay. I will repeat the things again also. So if you have any query, just listen with patience. So 18,000 is his trading income in both of the situations, obviously. Dividend income. That is 5,000 in both of the situations. Done. His total income 18,000 and 5,000. And here also 18,000 and 5,000. Now, trading loss relief of 31st March 2026. Now, when he will hit his trading loss relief of 31st March 26, that loss is of 21,000. So 18,000 will offset here and 3,000 will offset here. Okay. When you will offset your trading loss of 21,000, 18,000 will offset here and 3,000 will offset here because the total is 21,000 pounds. 21,000 pounds. Sir, will you repeat the things again? Yes, I will repeat the things again. So revised total income. Here it remains same at 18,000 and 5,000 and here it falls to 0 and 2,000. Then comes your personal allowance. 12570, obviously used in non-saving income and nothing in dividend. But if you are going for loss relief, then your non-saving income has fallen to 0 and dividend income is only 2000. So when you will deduct your personal allowance, you cannot deduct 12570 from 2000. So now, if you look at your taxable income, sir, will you repeat the things again? Yes, I will repeat. Just listen with patience. Here it is 5430 and here it is 5000. And here both of the values have fallen to 0. Now, what is the income tax? Okay. So, non-saving 5430 into 20%. So that gives us 1086. And in dividend, it's 5,000 pounds. First 500 pounds are always taxed at 0% in dividend income. You all know that. And then since you are a basic rate taxpayer, so it's 8.75%. 8.75%. So that is 394. So your total income tax will be 1086 plus 394. That gives me 1480 pounds. And obviously here the income tax has fallen to 0. Sir, please repeat it again. Yes, I will repeat. Just listen to me first with patience. What are we doing? We are doing his tax with loss relief and without loss relief. Okay. He had two sets of income, non-saving and dividend. Trading income remains the same, dividend remains the same in both of them. So till the total income, the entire working is same. Trading loss of 31st March 26, 18,000 from non-saving and 3,000 from dividend because total trading loss was 21. Total trading loss was 21. Okay. So 18 and 3. So now here it has fallen to 0 and here it has fallen to 2000 because 5000 minus 3 it's 2000. You will deduct personal allowance. Okay. Without loss relief, complete personal allowance is available. With loss relief, you only got personal allowance of 2000 because rest of the income was already declined. It was restricted. Okay, what we call as it was restricted. You got taxable income and you calculated your tax. Okay, without loss relief, your tax was 1480. With loss relief, your tax has fallen to 0. So what your tax saving will be? Tax saving will be 1480 minus 0 pounds. So your tax saving is 1480 pounds. Sir, can you please repeat it? Sir, why didn't you do it directly? See, if someone want to do it directly, let me do it for him also. If you would be doing directly, what you need to understand is that even if you will offset your loss of 21,000, you will not get saving on 21 because his total income is 23 and from that 12570 is already exempted. So the income which is getting taxable is only 10430 because from 23,000 12570 is already covered due to personal loss. So you have to calculate the loss relief saving on this 10430 only, which is 5000 plus 5430. Now this 5430 is non-saving. Non-saving has its own rate. And 5000 is dividend, which has its own rate and you have to look at 0% tax band also. So this is the reason why whenever you feel that okay, personal allowance, tax bands, two type of income, everything is getting involved. So the safest way is to go with tax with loss relief and without loss relief working and take the difference of both of them. We have seen such questions in past paper revision sessions in other questions also. So John can offset against current year total income, but that won't give any tax saving. The reason being is that in current year he only has dividend income which is already covered due to personal loss. If he offsets capital gain, then also no benefit because his capital gain was also covered due to the loss and the annual exemption. If he goes for previous year, then in that case he can get a saving because in previous year he was paying certain tax. If he will go back and offset it, he can save his tax which he was paying of 1480, because without loss relief this was his tax, and with loss relief his tax falls to 0. So this is his saving. Okay. Currently, we have explored the situations when John deals with his loss himself. But if you look at the question, there was one more thing. Suzanne and John wish to take all necessary actions to minimize the total tax payable by them as couple. Suzanne has heard that there is scope to save tax through the transfer of assets between spouse. Now, transfer of asset, only one possibility exists, that if Suzanne give this 15 hectare of land to John and John sells it into the market rather than Suzanne. That is the only possibility. Okay, let's look at that possibility. I know that you guys have some questions in your mind, but just think, in this entire question, this 11 marks requirement was the one in which you have to use the mind. Otherwise, it was a very easy requirement. So let's look at that possibility. Okay, so now we are moving towards one interesting planning which he referred in the question also, that Suzanne has heard that there is a scope to save tax through transfer of asset between the spouses. See, till now we have already explored that how the John can utilize the loss on his own. If he offsets against his current year total income, saving is 0. If he offsets against his own capital gain, the saving was 0. If he was going for previous year total income, in that case he was saving his tax of 1480 which he was already paying, but with loss relief it was falling to 0. So in this option only he was saving 1480 pound, which was his tax liability of previous year. Now another option is that Suzanne transfers her 15 hectares of land to John, and then John disposes it to third party rather than Suzanne selling it directly. Now just listen to me carefully, you will be able to understand like what we are trying to do. See, that's the only way through which we can achieve this point. Suzanne has heard that there is a scope to save tax through transfer of asset between spouse. Now obviously John won't be transferring anything because John has the loss. Suzanne can transfer this asset, this 15 hectares of land, and then rather than Suzanne selling it to the market, John will sell it for 80,000 pounds. Okay, transfer from Suzanne to John will be intra-spouse transfer and it will be at cost. Now, when John will sell it, chargeable gain of how much? If you remember the chargeable gain, if we just scroll up, this chargeable gain of 44660, chargeable gain of 44660 will arise on John rather than Suzanne. Okay. Now in tax year 2025-26, Suzanne tax capital gain tax will reduce to 0 and John's capital gain tax will be, see, it's very important that you listen to me carefully, because now Suzanne has given that asset to John and John will sell it in the market. So obviously Suzanne won't be paying any capital gain tax. Okay, she won't be paying any capital gain tax in relation to sale of land. Suzanne's capital gain tax in relation to land will reduce to 0 and John's capital gain tax will be. Now listen to me carefully. See, John's existing capital loss of 2025-26 against painting destroyed. If you remember, see, it's very important that you listen with patience. John had this loss of painting of 8,000. Okay, it was his existing loss. Okay, then John's existing capital gain of 2025-26 against sale of shares. So this gain on sale of shares was 9,600 pounds. That also will come here. Okay. Now, say gain on sale of 15 hectares of land. So this will be 44660. His net chargeable gain for 2025-26 will be 9,600, 44660 and minus 8,000 loss. So it's 46260. Okay. Now he will claim loss relief of trading loss of 31st March 2026. This trading loss relief. See, I will repeat each and everything again, so your patience is very important. His trading loss of 31st March 2026 was 21,000. Now what will happen is that he will be able to offset the loss relief of 21,000 pounds here. Okay, sorry, 21,000 was the total loss. So he will be able to set off 16,000 here. Why? Total trading loss, listen to me very carefully, was 21,000. It will be used in income tax return against total income of 2025-26 of 5,000 pounds, which is his dividend income. Because in order to offset the capital gain, you first have to offset the total income in income tax return. In income tax return of 25-26, he has this dividend income. Even though it won't generate any saving, but in order to offset the capital gain, it is necessary that he first offset the total income. Okay, I will repeat the things again. Remaining chargeable gain is 46260 minus 16,000. So this gives us 30,260 pounds. Then he will deduct his annual exemption 3,000. This will give taxable gain of how much? 27,260. Capital gain tax of John will be 27,260 into 10% because John is a basic rate taxpayer. So this will give us 2726. Okay. Capital gain tax saving will be of how much? Will be of Suzanne was paying CGT of how much? Was paying CGT of this 8932. Suzanne was paying CGT of 8932 and John is paying CGT of 2762. This gives capital gain tax reduction of how much? 8932 minus 2762. So this gives us capital gain tax saving of 6170 pounds. Okay. So this means that rather than John using his trading loss against his own total income of current year or against his own capital gain or doing a carry back and saving 1480 pounds, it's better that what he do is that he take that 15 hectare of land from Suzanne, okay, transfer between spouses at cost, and then include it in his own CGT return. Okay. Now I know that some of you guys might have some confusions in the mind. That's very much normal. Okay. So if I give final recommendation, it is advisable for John to take 15 hectares of land from Suzanne as an intra-spouse transfer and then relieve his trading loss in his capital gain tax return as that generates maximum tax saving of 6170 pounds for the couple. Okay, so please repeat it again. Yes, I will repeat it. It's an interesting requirement for 11 months. See, the question was that advise how Suzanne and John as to which approach to use the available loss will save the tax most collectively, the couple's tax. So first was that, okay, the loss was of John. He used it on his own. So the John had this loss in the year 31st March 26, which is 25-26. And obviously trade was in the loss. Any other income was his dividend income. So if he offset his total income, the benefit will be zero because 5,000 was already covered due to personal allowance. Okay. Then after offsetting total income, he can go for his capital gain tax. His capital gain tax of 25-26 was also zero because it was already covered by his loss and annual exemption. Another option was that he carry back the loss to previous year. Now in the previous year, we did this working of tax with loss relief and without loss relief because the tax rates of dividend were also involved. Personal allowance impact also need to be considered. So we included his income still here. 18,000 was his trading income and 5,000 was the dividend. Now here we offset his loss of 21,000. Okay, without loss relief, with loss relief, we did his working and we got to know that his income tax of 1480 will decline to zero, which will be his saving. Now the question told us, see, we don't think in this way normally. We don't think in this way normally. The question told us that Suzanne has heard that there is scope to save tax through transfer of assets between spouse. That triggered us that what transfer of asset can be done. See, the trading loss is with John. John cannot give this loss. But what he can do is that he can take this asset from Suzanne. Suzanne had this chargeable gain of this 44,660 on selling this 15 hectares of land. So rather than Suzanne selling it, why not John take it at cost to cost? Because within the spouses, the assets are transferred at no gain, no loss at their cost. And now John sells it in the market. So in this situation, his existing loss, his existing gain, that remains the same. Gain of 15 hectares of land, that gives us the net chargeable gain 46,260. We offset our loss relief. Now our trading loss was 21,000. You can't come to CGT return directly. In individual losses, you can't come to CGT return directly. You first have to offset the total income. So total income of the year was 5,000, which was the dividend income. Obviously on this, we were not getting any saving because it was already exempted due to personal loss. But the remaining loss, 16,000 we offset here. We got remaining chargeable gain. We hit annual exemption. We got taxable gain. John is a basic rate taxpayer because his income tax return stands at zero. Suzanne was paying CGT of 8932 and John is paying CGT of 2762. Now that 15 hectares belong here. So the CGT reduction is 6170. So the highest tax saving for the couple is in this option. Because if John uses on his own, option 1 no saving, option 2 no saving, option 3 saving of 1480. But if he takes that 15 hectares of land from Suzanne and then he sells it, then in that case, the tax saving for the couple is highest. Okay, I have attempted my best to repeat it again and again so that you guys can understand it. Still, if anyone has any query, you all have my WhatsApp number to ask. So it was a good 11 marks requirement. Now comes the last requirement for just 2 marks. So let's look at it also. And then our question will be done. So, advise John of the potential advantage of a business registering voluntarily for VAT and whether his business is likely to receive tax refunds from HMRC as a result. So let's look at it. Okay, before moving forward, there's a bit correction in my calculation. So let me correct it. 27260 into 10%, that gives us 2726, and then 2726 minus 8932, that gives us 6206. By mistake, I've written 6170. 6206. Okay, so that's a bit correction which I've done. So it was just a calculation mistake. Now, here also 6206. So basically 8932 minus 2726, that gives 6206. Now, coming back to this requirement C, only one statement was written here where John has heard that voluntarily VAT registration of his business may mean he can reclaim tax from HMRC. Yes, that's true. Once you get registered for VAT, you can able to recover your input VAT, but it has to be related to taxable supplies. If you read here, it's a very important statement. The business is not VAT registered, but makes supplies that would be treated as wholly exempt under the VAT legislation. So if you're dealing in exempt supplies only, the problem is that your input VAT is not recoverable. The reason being is that for exempt supplies, the input tax recovery is not allowed. So advise John of the potential advantage of a business registering for VAT. The first question, what's the advantage? The advantage is that the business is not required to monitor its compulsory VAT registration limit, because okay, you are already registered, so you don't have any fear of fine or penalty if you miss out the limit. And also, once you get registered for VAT, it gives a better impression on other businesses that okay, this business is registered for VAT, so they must be having good business. And then the question is whether his business is likely to receive tax refunds from HMRC as a result. His business won't receive. Normally, the businesses receive, but his business won't receive because he is not dealing in taxable supplies. It's just a requirement of 2 marks. Okay. Potential advantage of getting VAT registered is that a business is not required to monitor compulsory VAT registration limit then, as otherwise if a business misses out compulsory VAT registration limit, then it may face a fine, okay, if its taxable supplies exceed VAT registration threshold and registration is not done on time, then risk of penalty or a fine exists. So that risk is ended once you get registered. You are not required to monitor the limit anymore. 1 mark for this. Or you can write another advantage also, like once you get VAT registered, it gives a good impression on other businesses because okay, it shows that okay, that business must have good activity. Secondly, normally when a business is registered for VAT, it can recover its VAT paid as an input tax against its taxable supplies portion. However, for John's business, it will not apply, and his business is wholly related to exempt supplies only. As his business is only related to exempt supplies only, since it is related to exempt supplies only, so he will not be able to recover the input VAT. Normally, the input VAT is recoverable, but if it is related to taxable supplies, but if your business is wholly dealing in exempt supplies, then VAT paid on raw material is not recoverable. So if I look at this entire answer, I would say that it's very much difficult, but yes, there were some areas where good understanding of the concepts was really important. First, it was about disposal of 15 hectares of land. In that, it was really interesting thing that 11 hectares were already sold, so you have to do that base cost working. Then this was an easy one. Okay. Then stating the loss reliefs was also easy, I believe. But then 11 marks requirement in relation to doing the loss planning, that was interesting. Okay. And obviously, interesting thing was that an asset transferred between the spouse and offsetting the gain against that. Uh, that was something which was slightly referred in the question. See, that is what I always say, that when you are going for exams like advanced taxation, you can always expect different type of requirements examiner can ask you. So with this question is done. I have done my best to explain it and repeat the things again and again so that things get settled in your mind. But still, if you have any query, you can always connect with me directly on my WhatsApp number. Okay. Thank you and best of luck for your exams.